Good morning. Nature of capital budgeting. Capital budgeting is a managerial technique of planning capital expenditures whose benefits are expected to extend beyond 1 year, such as expenditure on acquisition of new buildings, improvement of existing buildings, replacement of plant and machinery, acquisition of new facilities, new machines, etc. Permanent addition to working capital, research and development expenditure are also regarded as capital expenditure. Capital budgeting technique involves matching of expected net cash inflows from the project with anticipated cost of the project. These two components of capital budgeting technique are determinant of investment outlay. Utility of capital budgeting. Capital budgeting is the most potent technique employed in assessing financial viability of projects and, for that matter, allocating prudently the funds among the projects by providing useful guidelines in identifying useful projects and ranking them in terms of economic desirability to choose the most promising one. Thus, it helps a firm in strengthening its financial health and so also its competitive position. Investment proposals and administrative aspects. Capital budgeting process involves several steps. The first step in the capital budgeting process is to assessing the first step in the capital budgeting process is to assemble a list of proposed new investments together with the data necessary to appraise them. Although practices vary from firm to firm, proposals dealing with assets acquisitions are frequently grouped according to the following four categories: replacements of existing or old projects, expansion, additional capacity in existing product lines, growth, new product lines, other, for example, pollution control equipment. Choosing among alternative proposals. In most firms, there are more proposals for projects than the firm is able or willing to finance. Some proposals are good, others are poor, and methods must be developed for distinguishing between the good and the poor. Essentially, the end product is a ranking of the proposals and a cutoff point for determining how far down the ranked list to go. In part, proposals are eliminated because some are mutually exclusive. Mutually exclusive proposals are alternative methods of doing the same job. If one piece of equipment is chosen, other will not be required. Thus, if there is a need to improve the materials handling system in a chemical plant, the job may be done either by conveyor belts or by forklift trucks. The selection of one method makes it unnecessary to use the others. They are mutually exclusive items. Independent projects are those that are being considered for different kinds of tasks that need to be accomplished. For example, in addition to the materials handling system, the chemical firm may need equipment to package the end product. The work would require a packaging machine, and the purchase of equipment for this purpose would be independent of the equipment purchased for materials handling. The firm may undertake any or all independent projects. Finally, projects may be contingent. For example, there may be only one way to build a football stadium, but two ways of housing it, in a metal structure or a geodesic dome. Because the stadium and its housing are contingent, the analysis requires that we consider them together. Hence, we would want to compare the stadium within a metal structure with the alternative of the stadium within a geodesic dome. Choosing among alternate proposals. To distinguish among the many proposals that compete for the allocation of the firm's capital fund, a ranking procedure must be developed. This procedure requires calculating the estimated cash flows from the use of equipment and then translating them into a measure of their effect on shareholders' wealth. First, we turn our attention to the problem of estimating cash flows for capital budgeting process. This is the main part of today's counseling. Estimating cash flows for capital budgeting. Cash flows for capital budgeting purposes are defined as the after-tax cash flows for an all-equity financed firm. Algebraically, this definition is equivalent to earnings before interest and taxes, EBIT, less the taxes the firm would pay if it had no debt. We have just discussed that it is for an all-equity financed firm, means there are no debts. Taxes on EBIT plus non-cash depreciation charges. Or you may say cash flow is equal to EBIT minus taxes plus depreciation. Or in other words, you may say whatever cash we actually receive. Earning before interest and tax is actually the difference of inflows and outflows of cash. And as it includes depreciation in the outflows, therefore depreciation has been here added back and taxes are deducted. Note that this definition of cash flows is unaffected by the firm's financing decision. For example, the amount of debt which it uses. Consequently, the investment decision and the financing decision are kept separate when we use this definition of cash flows for capital budgeting purposes. Now, evaluating investment proposals. The point of capital budgeting, indeed, the point of all financial analysis is to make decisions. And decisions that will maximize the value of the firm. The capital budgeting process is designed to answer two questions. Which of several mutual exclusive investments should be selected? And how many projects in total should be accepted? Among the many methods used for evaluating investment proposals, 5 are important and they are discussed here. First one is payback method. or payback period. This method is concerned with number of years required to return the original investment. Say if we invest 1 crore in a business today, in number of years, when will this 1 crore will be back to me? This is known as payback period. Return on assets or return on investment. An average rate of return on assets implied. If we continue with the same example, rupees 1 crore will be back, say in 4 years. Means on an average, we will receive 25 lakhs per year. And as we have invested rupees 1 crore, rupees 25 lakh will be 25% return on assets or return on investment. Net present value method. Present value of expected future cash flows discounted at the appropriate cost of capital minus the cost of investment. This net present value we have also discussed in the last counseling session. There is a distinction here. In case of payback period or return on assets method, we have taken the absolute return. Means 1 crore invested today, 25 lakhs we will get after 1 year, 25 lakhs we will get after 2 years, after 3 years, and after 4 years. But rupees 25 lakhs after 1 year is not equal to rupees 25 lakh of today's, because we have not given consideration to the interest involved or the value of the money. In this method of net present value method, we take discounted value. Means 25 lakhs after 1 year, what is present value of 25 lakhs? 25 lakhs after 2 years, what is the present value today? 25 lakhs after 3 years, what is the present value? And 25 lakhs after 4 years, what is the present value? Then these present values are added and they are compared to the original investment, or you may say cost of investment, and the difference is known as the net present value method. Internal rate of return method. Interest rate which equates the present value of future cash flows to the investment outflow. Means whatever we are getting in future, what is their present value, the total of their present value is equated to the investment outlay. At which rate this is equal, that is known as internal rate of return method. We will discuss this method just now in detail. Profitability index. It shows the relative profitability of any project or the present value of benefits per rupee of cost. Before discussing these methods, general principles involved in these methods. When comparing various capital budgeting criteria, it is useful to establish some guidelines. What are the properties of an ideal criteria? The optimal decision rule should have 4 characteristics. Number 1, it will select from a group of mutually exclusive projects the one which maximizes shareholders' wealth. Number 2, it will appropriately consider all cash flows. Number 3, it will discount the cash flows at the appropriate market determined opportunity cost of capital. Number four, it will allow managers to consider each project independently from all others. This has come to be known as the value additivity principle. The table in the next slide gives the cash flows for four mutually exclusive projects. They all have the same life, say 5 years, and they all require the same investment outlay, rupees 1500. You may take them rupees 1500 lakhs, 1500 crores, or maybe only rupees 1500. Once accepted, no project can be abandoned without incurring the outflows indicated. For example, Project A has negative cash flows during its fourth and fifth years. This is outlays in this project. Once the project is accepted, these expected cash outflows must be incurred. An example of a project of this type is a nuclear power plant. Decommissioning cost at the end of economic life of the facility can be as large as the initial construction cost, and they must be taken into account. Now, we have taken this example, cash flows of four projects. In the first line, there are outflows, or this is investment, 1500 in project A, same in B, C, and D. And as it is the today's cost, therefore present value factor is 1. Means 1500 is equal to 1500 on at today. Now inflows, this 1500 is outflow. Now inflows in the project A, 150 first year, 1350 second year, 150 third year, and minus this in fourth and fifth year. In the project B, there are no inflows in the first and second year. Third year, fourth year, fifth year are the inflows. In project C, the inflows are all the 5 years, maximum in the fifth year. And in the same way, project D, there are inflows in all the 5 years, and the maximum is in the fifth year. Present value factor. The present value factor is actually based on the formula of compound interest. Or you may say the principal amount of the amount rupee 1 after 1 year is 0.909. In other words, you may say if you invest 0.909 or almost 91 paisa today, after 1 year it will become rupee 1. In the same way, if you invest 0.826, means almost 83 paisa today, after 2 years it will become rupee 1, and so on. This we have taken as an example. You may take any figure in place of all these figures, and the discussion will be the same. The last column of table shows the appropriate discount factor for the present value of cash flows. Assuming that the appropriate opportunity cost of capital is 10%. If you assume that the cost of capital is anything else than 10%, then this last column will have different values. Since all four projects are assumed to have the same risk, they can be discounted at the same interest rate. Now we turn our attention to the actual implementation of five above mentioned capital budgeting techniques. The payback method, the return on assets, the net present value, the internal rate of return, and profitability index. We shall see that only one technique, the net present value method, satisfies all four of the desirable properties for capital budgeting criteria. Because in all the four projects, whatever we have invested will come back after some time. Now we are discussing one by one every method. The payback period is the number of years required to recover the initial capital outlay on a project. The payback period for the four projects are given above table are given below. Now we discuss one by one. In project A, the 1500 invested today will be back after 2 years. 150 plus 1350 means 1500. Means payback period is 2 years. In project B, as the inflow in first year is only 0, second year it is 0, third year, fourth year, 450 plus 1050. It will become 1500, the total of this. Therefore, the payback period is 4 years. In the third project, 150 plus 300 plus 450 plus 600. Total is 1500. And therefore, the payback period is here also 4 years. In the fourth project, 300 plus 450 plus 750. Total is 1500. Therefore, payback period is 3 years. Here we have given it. The project A, 2 years, project B and C, 4 years, and project D, 3 years. If management were adhering strictly to the payback method, then project A would be chosen as the best among the four mutually exclusive alternatives. Even a casual look at the numbers indicates that this would be a bad decision. The difficulty with the payback method is that it does not consider all cash flows and it fails to discount them. If you see in the project A, we have recovered 1500 in 2 years. But if we see the whole life of the project A, the total inflows are 150 plus 1350 plus 150 means 1650 minus this 750 only 900. Therefore, there is negative means we are investing 1500 and we are receiving only 900. Therefore, it is a negative return. No importance has been given in this period. Means as per payback decision, project A is the best, but actually the project A is the worst. Moreover, no importance has been given to the value of money. The value of money is not equal of the value of today's money is not equal to the value of money after 1 year, 2 year, or 3 year. The next method is return on assets or return on investment. The return on assets, which is also sometimes called the return on investment, is an average rate of return technique. It is computed by averaging the expected cash flows over the life of a project and dividing the average annual cash flow by the initial investment outlay. For example, the ROA for project B in the above table is computed from the following definition. ROAE for the 4 projects. Now you see again the table. We have invested 1500 and we have received back only 900. And 900 in 5 years means the return is minus 8%. We take one example, say project C. Project C, the total inflows are 150 plus 300, 450 plus 450, 900 plus 600, 1500. Means 1500 is payback after 4 years, and then we receive 1875. 1875 in 5 years, or you may say 375 per year. And 375 per year on 1500, it is 25%. In the same way, you may calculate ROE or ROI for all the projects. The ROA criteria choose project B as best because here the return on investment is 26%. The major problem with ROA is that it does not take the time value of money into account. We have just discussed two deficiencies in the payback period. Number one, the inflows for the whole period as well as the discounting of the money. The problem of inflows for the whole period has been removed in this method, but there is still the problem of time value of money. We would have obtained exactly the same ROA for project B, even if the order of cash flow had been reversed. With rupees 1950 received now and rupees 1050 at the end of year 1, 450 at the end of year 2, and 1500 at the end of year 5. But no one with a positive opportunity cost of capital would be indifferent between the alternatives. Opposite ordering of cash flows would always be preferred. Now the present value method. The last three methods, present value method, IRR, and profitability index, they are considered better as compared to the first two methods. Another method based on discounted cash flow approach implied to evaluate financial viability of investment projects is the present value method, which involves discounting of streams of future cash earnings to present value at required rate of return to the firm. That is the cost of capital. For ranking projects under this method, net present value is computed. Project with highest positive net present value is accorded the highest priority. I have taken one example of project C. Here I have taken the values from that table. Minus 1500, 150, 300, 450, 600, 1875. The same values are taken here, and present value factor is the same 1.909, 0.826, 0.751, 681 that is taken here. Now the calculation. 1500 invested today. As the present value is 1, it is equal to 1500. So this is very simple. 1500 today equal to 1500 today. Now the inflow is 150 after 1 year. The present value factor is 0.909. 150 multiplied by this comes to this. 0.909, as we have just discussed, that 0.909, if you invest today, it will become rupee 1 after 1 year. In the same way, 0.826 invested today will become rupee 1 after 2 years. 0.751 invested today will be equal to 1 rupee after 3 years, and so on. 0.683 after 4 years, 0.621 is equal to rupee 1 after 5 years. Reverse means the present value of rupee 1 after 1 year is only 0.909. Present value of rupee 1 after 2 years is equal to 0.826 today. And therefore, they are present value factors. These two figures have been multiplied. 150 multiplied by 0.909, it is 136.35. 300 multiplied by 0.826, 247.8. 450 multiplied by 0.751, 337.95. 600 multiplied by 0.683, 409.8, and 1875 multiplied by 0.621, it is 1164.38. If we total these 5 values, the total will be 2296.28. Out of that, 1500 investment is deducted. Therefore, the net present value is 796.28. In the same way, you can calculate net present value of all the 4 projects. And the final answer is that for project A, it is negative, rupees 610.95. Project B, 766.05. Project C, 796.28. And project D, 778.80. If these projects were independent instead of mutually exclusive, we would reject A and accept B, C, and D because they have got positive NPV. Since they are mutually exclusive, we select the project with the greatest net present value, that is project C. The NPV of the project is exactly same as the increase in shareholders' wealth. Or you may say, if you select project C, after 5 years, the shareholders' value will increase by 796.28. Now the fourth method, internal rate of return. The internal rate of return is defined as the interest rate that equates the present value of expected future cash flow or receipts to the initial cash outlay. The internal rate of return may be found by trial and error. First, compute the present value of the cash flows from an investment using an arbitrarily selected interest rate, say, for example, 10%. Then compare the present value so obtained with the investment cost. If both equates, then the IRR is 10%. But if the present value is higher than the cost figure, then try a higher interest rate, more than 10%, say 11%, 12%, 20%, or like that, and go through the procedure again. Conversely, if the present value is lower than the cost, then lower interest rate should be applied, say 9%, 8%, and repeat this process again and again. Continue until the present value of flows from the investment is approximately equal to its cost. Then that interest rate which brings about this equality is defined as the internal rate of return or IRR. Now, computation for the IRR for project D in the above table has been given here as an example. These figures, these two columns, we have taken from the table. This minus 1500, 300, 450, 750, 750, 900. And the present value has also been taken from the table. At 10%, the outflow is 1500, inflow is this, so net inflow is 778.8. It means the rate of return is more than 10%. Now in the second step, we have taken 20%. At 20%, the present value factor has changed. This is the present value factor. The same thing which we have discussed just now, means 0.8333 today will be equal to rupee 1 after 2 years, and so on. Now, still the present value is positive, 219.75. Means internal rate of return is more than 20%. Now we have taken 25%. On 25%, this has come. Now the present value factor is this. Still it is positive, 14.70. Means the present value, the internal rate of return is slightly more than 25%. Now we have taken 25.4. The present value factor has changed, and now it comes negative 1.65. Means the internal rate of return is slightly less than 25.4, or you may take it as almost 25.4%. Means for these inflows, the actual rate of return which we are getting is almost 25.4%. If the cost of capital is less than it, then certainly the investment is good. If the cost of capital is more than 25.4, then we will be at loss. The last method, profitability index. Another method that is used to evaluate projects is the profitability index, or the benefit cost ratio as it is sometimes called. Present value methods had the merit of simplicity in as much as it helps the management in choosing the most profitable proposal. Further, while evaluating and ranking projects, it focuses on one of the primary objectives of a firm, that is increasing value of the firm. However, main drawback of this approach is that it does not take into consideration size of investment outlay and net cash benefits together while ranking projects. This may at times lead to faulty decisions. Profitability index method has come to be employed to overcome the above drawback and to ensure rational investment decision by establishing relationship between the present values of the net cash flows and net investment outlay. The profitability index shows the relative profitability of any project or the present value of benefits per rupee cost. Now take one example. Say project D. Here the inflows are 300, 450, 750, 750 plus 900. Total will be 300 plus 450, 750 plus 750, 1500 plus 750, 2250 plus 900, 3150. 3150 divided by 1500. It will come to 1.52. In the same way, we can calculate for every project. And this has been given here. I think it is very much clear to you that this profitability index method is the best. A project is acceptable if its profitability index is greater than 1, and the higher the profitability index, PI, the higher the project rank. Mathematically, the NPV, the IRR, and the PI methods must always reach the same accept reject decisions for independent projects. If a project's NPV is positive, its IRR must exceed cost of capital, that is K, and its PI must be greater than 1.0. However, NPV, IRR, and PI can give different rankings for pairs of projects. This can lead to conflicts between the three methods when mutually exclusive projects are being compared. Capital budgeting methods in practice. The above discussion lead us to conclude that IRR, NPB, and PI methods will result in the same decision, except in certain cases involving mutually exclusive projects or non-normal cash flows. The question that arises, which capital budgeting techniques do firms actually use in practice? Lawrence Gitman and John Forrester conducted a survey to help answer this question. Gitman and Forrester received 103 usable responses from a survey sent to 268 major companies known to make large capital expenditures. They found that the responsibility for capital budgeting analysis generally rests with the finance department. The respondents also stated that defining projects and estimating their cash flows were the most difficult and the most critical steps in the capital budgeting process. The following table summarizes the capital budgeting methods used by the respondent firms. The result indicates a strong preference for discounted cash flow budgeting techniques, that is NPB, IRR, and PI, with the dominant method being RRR. If you see the result, in case of primary, IRR 60, ROE 28, NPV 11, payback 10, and PI 3. In case of secondary, number is like this. However, the heavy use of ROA and payback as primary technique indicates that not all firms were technologically up to par and economic sense. Means the firms with lower investment or of small firms, they normally use payback period or ROA. Capital budgeting methods in practice. It may also be noted that almost all the respondents use at least two methods in their analysis, and as evidenced by the 112 primary methods from 103 respondents, some firms use more than one primary method. Although the questionnaire did not bring this point out, we suspect that many of the analysts of firms which use the IRR as the primary method recognize its drawbacks, yet use it anyway because it is easy to explain to non-financial executives, but use NPB as a check on IRR when evaluating mutually exclusive or non-normal projects. It is also doubtful the payback method can be used as a liquidity and or risk indicator. Hence, to help choose among competing projects whose NPBs and or IRR are close together. One interesting and encouraging note is that when compared with earlier surveys, Gitman and Forrester found that the discounted cash flow methods are gaining its uses. As regards this survey was in case of the United States companies, as regards the use of assessment methods employed by Indian corporate, a study of 100 medium and large scale companies conducted in 1994 reveals that Indian companies have started using discounting techniques more than non-discounting approaches. Although some companies are still using payback period approach, it is the net present value technique which is used quite widely, particularly by companies which have high sales value and large paid up capital. Small and new companies are still relying on traditional approach like payback period. Now the next part, project implementation and control. Monitoring. Monitoring is collecting, recording, and reporting information concerning an all aspect of project performance that the project manager or others in the organization wish to know. In our discussion, it is important to remember that monitoring as an activity should be kept quite distinct from controlling, which controlling uses the data supplied by monitoring to bring actual performance into approximate congruence with planned performance, as well as from evaluation, through which judgments are made about the quality and effectiveness of project performance. Designing of the monitor system. The first system in setting of any monitoring system is to identify the key factors to be controlled. Clearly, the project manager wants to monitor performance, cost, and time, but must define precisely which specific characteristics of performance, cost, and times should be controlled, and then establish exact boundaries within which control should be maintained. And there may also be other factors of importance worth noting. At least at certain points in the life of project. For example, the number of labor hours used, the number or extent of engineering changes, the level of customer satisfaction, and similar items may be worthy of note on individual projects. But the best source of items to be monitored is the project action plans. Actually, the set of action plans that describe what is being done, when, and the planned level of resource uses for each task, work package, and work unit in the project. The monitoring system is a direct connection between planning and control. If it does not collect and report information on some significant element of the plan, control can be faulty or missing. The measure the measured and reported to the control system, but it is not sufficient. For example, the project manager might want to know about changes in the client attitude towards the project, information on the morale of the project team might be useful in preparing for organizational or personal changes on the project. These two latter items may be quite important but are not reflected in the project action plans. Unfortunately, it is common to focus monitoring activities on data that are easily gathered rather than important, or to concentrate on objective measures that are easily defended at the expense of softer, more subjective data that may be more valuable for control. Above all, monitoring should concentrate primarily on measuring various facets of output rather than activity. It is crucial to remember that effective project managers are not primarily interested in how hard their project teams work. They are interested in results. Given all these performance criteria, standards, and data collection procedures must be established for each of the factors to be measured. The criteria and data collection procedures are usually set up for the life of the project. The standards themselves, however, may not be constant over the project's life. They may change as a result of altered capabilities within the parent organization or a technological breakthrough made by the project team. But perhaps more often than not, standards and criteria change because of factors that are not under the control of the project manager. Next, the information to be collected must be identified. This may consist of accounting data, operating data, engineering test data, customer reaction, specification changes, and the like. The fundamental problem in this regard is to determine precisely which of all the available data should be collected. It is worth repeating that the typical determinants for collecting data too often seems to be simply the ease with which can be gathered. Of course, the nature of the required data is dictated by the project plan as well as by the goals of the parent organization and by the fact that it is desirable to improve the process of managing projects. Therefore, the first task is to examine the project plans in order to extract performance, time, and cost goals. These goals should relate to some fashion to each of the different levels of detail. That is, same should relate to the project, some to its tasks, some to work packages, and so on. Data must be identified that measure achievement against the goals and mechanism designed for gathering and storing such data. Similarly, the process of developing and managing projects should be considered and steps taken to ensure that information relevant to the diagnosis and treatment of the project's organizational infirmities and procedural problems are gathered. That's all. Thank you. हाँ, टाइम हो गया ना 2 मिनट